Let's be real, above everything else, we all want our investments to make us more money. But in a world dealing with climate change, biodiversity loss, and so many more issues, it's hard not to feel guilty when your money ends up supporting fossil fuels, deforestation, or companies with poor labor practices. Most of us don't want to profit at the expense of our planet or other people. It just doesn't feel right. So that leaves us with one question. Can we actually maximize our returns and still avoid this? Let's take a closer look at sustainable investing and these three questions. Number one, what is the best option for investing sustainably as someone just starting out? Secondly, can you even get good returns compared to standard products? And finally, what's the impact? Is it actually worth it? Hi, I'm Moritz. I'm an engineer and I've been consulting businesses on sustainability issues for 4 years. I started this channel to share productivity tips and insights on sustainability and technology. Now, as we are talking finance today, before we dive into the video, I have to give a short disclaimer. The information provided in this video is for informational purposes only and is not financial advice. I'm also not a financial advisor. Now that we've got this out of the way, let's move on to the first question. In this first section, I'm gonna provide you with general options for how to invest your money, and then tell you which one I believe is best suited for sustainable investing for beginners. And also probably everyone else who doesn't want to spend a ton of time on the topic of investing. And that's where you might ask yourself, isn't that the job of a bank advisor? Well, most advisors currently believe their job is only to get the client the best return possible, but have no idea about sustainability criteria. This means you'll end up with products that include companies you wouldn't want to support. Bank advisors also often push products that benefit them and the bank, not you. So generally be careful and do your own research. Blindly trusting an advisor can be a quick way to lose money. Alright, let's start with an option that's been on everyone's mind since Bitcoin surged in 2017 and 2024. Cryptocurrencies. Yes, cryptocurrencies can yield great returns, but they're generally very risky and volatile. And from the standpoint of sustainability, mostly a disaster, although some coins have changed the underlying validation mechanism to more sustainable options. Overall, crypto isn't ideal for sustainable investing or beginners, so it's not suitable for our purposes. Then of course you have stocks. In the age of convenient trading apps like Trade Republic or Robinhood, it is easy to buy stocks, which makes applying your criteria also really easy. If you're happy with what the company does, buy it and skip the others. But then, will the stocks you've selected also perform well? This is where it gets risky. Even investor legends like Warren Buffett have a hard time selecting the winners in the stock market.
Occasionally I think I know enough to pick a winner, but not very often.
Only a small percentage of companies yield the best returns. Therefore, diversification is a general rule that investors use to make sure they avoid picking too many losers. That's why stock picking isn't suitable for most non-professionals, although it does let you choose specific companies you want to invest in. If you go to a bank or a financial advisor, you'll likely end up with an active fund. Funds profit from diversification because the fund managers select a bunch of stocks that they think will perform well or match certain criteria. And that is an advantage over picking a handful of stocks. But that's also where the problem lies. Actively managed funds are costly because you have to pay the managers. Every year, a significant portion of your returns goes to them and not you. That's also why financial advisors promote these products. They earn bonuses or commissions when you invest in them. In that case, their interests are directly opposed to yours. They profit when you pay higher fees, which reduces your returns. And that's not the only reason to avoid actively managed funds. Statistically, they perform worse than passive funds, which are not actively managed. So what are passive funds and who then selects which stocks to buy? This is where ETFs come in. And ETFs don't need management at all. Instead, they follow a predefined set of rules. ETFs are mostly passive investment funds that typically track certain stock market indices, for example the MSCI World or S&P 500, which are lists of stocks with specific weightings, usually based on market capitalization. The market cap is the total value of a company's shares. ETFs provide broad, global diversification in one investment, spreading risk across different sectors and regions. They are far more cost-effective than buying individual stocks, since you save on trading fees. And compared to active funds, you also save a lot on management fees as well. World ETFs with global diversification are generally the best investment for most people if you're in it for the long run. Markets go up and down and can perform poorly over a few years due to factors like economic downturns or geopolitical tensions. But despite short-term volatility, ETFs tend to go up over long time frames. Expected returns of an ETF like the MSCI World are around 7 to 8% per year, which is a lot compared to other asset classes. And that's amazing, but here's the dilemma. Investing in the whole market doesn't really seem sustainable since you end up buying all the companies you don't want to support, right? The good news is there are sustainable versions of popular indices used for ETFs like the MSCI World. Index providers like Morgan Stanley have created more sustainable versions of standard indices. That's where, for the most part, ESG or SRI comes in. First of all, let's look at what ESG actually means. Environmental factors include climate change, resource use, and waste reduction. Social factors cover human rights, fair wages, and product safety. Governance includes things like board diversity and executive pay. What the index providers do is they adjust their standard indices by excluding or reweighting companies based on a number of criteria in these fields. They assess companies, scoring them to enhance exposure to those that perform well in ESG areas. Companies that don't meet certain standards may be removed from the index altogether. For example, the MSCI World SRI Index excludes companies involved in alcohol, tobacco, firearms, and a few other fields. SRI, standing for Socially Responsible Investing, is often even stricter than ESG factors. There are also indices labeled low carbon, specifically addressing the reduction of greenhouse gases. For most people looking to incorporate sustainability into their investments, ESG or SRI filter world ETFs are a great choice, offering a good balance between impact and returns. Now, the downside is you have to put in some effort to decide which indices fit your needs. There are many options by now, but even ESG or SRI ETFs probably include some companies that don't fit your values. Unfortunately, that's part of the whole equation because standardized criteria cannot serve the diverse interests of every single person. Defining and managing ESG criteria is tough. You need a lot of data to track operations, supply chains, and more to get the full picture. Companies aren't always required to report ESG data, so greenwashing can be a real issue. Still, from a moral standpoint, investments aren't always black and white. A lot of criteria fall into a gray area, where you could argue both ways for a world index that has the goal to reach maximum diversification. Take, for instance, big tech companies. They offer innovative services that make our lives so much easier, but they might also have issues with data privacy, questionable labor practices, or contribute to social concerns like misinformation around elections. Thus, sustainability criteria vary, and it can be hard to find products that fully align with your values. Look for products that fit your needs. Be careful though, we still want a broadly diversified world ETF, not an actively managed fund or a themed ETF, for example on renewable energy, as these are far more risky. I will show you which ETFs I recommend later on. Now that we know the optimal investment vehicle, we want to make sure our money is still in good hands. Let's look at some common concerns against sustainable ETFs, especially against their standard counterparts. People often argue that you sacrifice a lot in diversification when investing sustainably. And diversification is essential for us in passive investing. Take the MSCI World SRI Index as an example. It includes about 400 stocks compared to the 1600 in the standard MSCI World Index. This difference might seem huge, but it is not as dramatic as it sounds. In fact, at a certain point, adding more stocks just doesn't make a big difference. So here's the reality. While sustainable indices leave out some sectors, they still offer a sufficient amount of diversification. But there is something else. Studies have shown that companies with higher ESG scores have slightly lower expected returns. Now, why is that? The reason actually makes me a bit happy and sad at the same time. It seems like people are already more willing to own the ESG part of the market and therefore create higher demand for these stocks. That's actually great news as it reflects positive values in the market. But it's also something understandable, I guess. Think about two businesses. One's making a positive impact on society, probably people are eager to support it. The other's shady, investors stay away. The higher demand for ESG stocks drives up their prices, which in turn lowers returns. However, these differences in returns are often minor, in the range of 1% here and there. And studies also show mixed results. We also need to be cautious here because we only have ESG performance data from the last few years, whereas classic indices like the S&P 500 have decades of historical data. The final point to consider is fees. Sustainable ETFs have slightly higher expense ratios because they manage smaller amounts of money compared to standard options. Still, the difference is minor, and there is low-cost options out there, which I'll share with you later. Summing it up, even with slightly higher fees and an eventual ESG premium, differences are still minor. Over the past 3 years, since the COVID-19 market dip, the performance of sustainable indices has been remarkably similar to their traditional counterparts. Now, as investors, we're always trying to predict the future. So let's explore how companies with higher ESG rankings could potentially benefit in the long run. Sustainable companies also profit as a business. Because when companies don't think about the future of the planet and society, they're less likely to think about the future of their business in a long-term perspective as well, which is not going to help them. Unsustainable practices pose a certain risk to the company and could be punished in the future. A company that treats its workers poorly might go unnoticed for a long time, but eventually it could get punished or caught in a scandal, and people might start choosing more ethical competitors. Looking into the future, it is uncertain whether ESG-focused companies will continue to slightly underperform. Things might change as regulations tend to become more strict over time. If policies are continuing to accelerate the transformation to sustainable technologies and practices, which for example in the EU currently seems to be the case, then companies proactively addressing ESG concerns will profit accordingly. And therefore ESG criteria reduce the risk of companies in your portfolio being beaten by upcoming regulation. The shift towards sustainable investing is no longer just about ethics, it's becoming a financial risk assessment tool. And that's also because consumer awareness is growing. Brands like Patagonia are thriving because they align with the values of an increasing share of eco-conscious customers. Even Apple wants us to believe they're doing a lot for the planet, which I hope they are. Yes, investing in sustainable companies involves a small bet on the future, but I believe we'll transition faster to more sustainable practices, and investors in ESG companies will profit accordingly. Finally, if you compare the worst case possibility of losing out on around 1-2% of your profits to other assets like housing, savings accounts, or gold, it becomes clear that ETFs outperform many other asset classes. And an ETF using sustainability criteria is still an extremely good investment. After looking at returns, an ESG or SRI version of a world ETF still looks like the optimal choice. But from an investor's perspective, we could still argue that any added risk without a clear benefit is unnecessary. Now that's why I want to show you the impact of sustainable investing in the last chapter. And this is where some financial experts on YouTube claim that sustainable investing doesn't make a difference, because someone else will just buy the dirty stocks anyway.
And of course the biggest problem is China.
And that's an excuse we hear often, where people want to discourage change, arguing that someone else will just continue what they're doing regardless. And sure, there is some truth to that, but it misses the bigger picture. The more money businesses get from investors, the easier it is for them to operate and grow. At the same time, lower demand for shares can make it more expensive for companies to raise capital via equity in the future, as they have to sell shares at a lower price. This means higher cost of capital for them, making it more expensive to fund their operations and growth. Sustainable companies, meanwhile, benefit from increased investor interest. They can raise funds more easily and at better rates, allowing them to invest more in their businesses. A sustained trend of divestment from harmful companies can increase their cost of capital and pressure management to make changes. If enough money flows into sustainable investments and away from others, it influences which sectors are attractive in the long run. Think of it like voting. Every dollar you spend or invest is like casting a vote for what you want to be built in this world. When you buy an organic product at the grocery store, you're casting a small vote for better farming practices. Now imagine putting thousands into your trading account and choosing an ETF with ESG criteria. That's a much bigger vote. Of course, there's always bigger fish out there in the market, but I still hope you get the idea. And actually, a lot of people are hopping on the ESG train right now. ESG ETFs are gaining more and more money, which means their impact is increasing. This pressures unsustainable companies to adapt or risk falling behind. In a capitalist society, which we've agreed on, our power lies in our money. Buying stock means becoming part owner of the company. If you had enough shares of a single stock, you could attend shareholder meetings and vote on these important issues, like environmental policies. But when you're investing through an ETF, that holds hundreds of stocks, that's not practical. Sustainability criteria in ETFs give you some of that decision power back, which belongs to you as an investor. And personally, I believe we should use this power to express our values to the companies we own, even if it's through an ETF. I feel that the risks posed by companies acting unsustainably, like contributing to climate change, are far greater for all of us than the risk of possibly losing a small percentage in returns. Investing in a way that mostly aligns with my values gives me peace of mind because I know I'm contributing to a better future. When lots of people choose sustainable investments, it sends a strong message. It pushes companies to rethink their practices and directs money toward businesses that care about the planet and society. Now, as promised, let me show you the different options for the MSCI World, probably the most popular world index of our time. Let's map the options on an impact scale. Keep in mind though that this is a simplified overview, as there are numerous options in each of the categories. Starting with the parent index, the MSCI World, where you have no impact and the lowest fees. To the MSCI World ESG with some impact and low fees. To the MSCI World SRI with low fees, but also higher impact owing to stricter selection criteria. Then we have specialized ETFs and green active funds with even stricter selection and higher fees, such as the German Umweltbank ETF. And finally, picking stocks, where you can tailor your portfolio exactly to your values. But I wouldn't generally recommend this due to less diversification, which brings the challenge of picking successful companies. Now, if I had to make a suggestion for a product, it would be the MSCI World SRI and the MSCI World ESG Enhanced. For me, these two strike the best balance between achieving solid returns, keeping fees reasonable, and making a positive impact. The iShares variant of both of them comes in with expense ratios of around 0.2%. If you're looking for a more sustainable option, there aren't many choices right now that align with the passive investment philosophy I recommend. However, I truly hope more will become available in the future. And the Umweltbank ETF available to German customers is already a great step into the right direction. Thanks for sticking with me through this exploration of sustainable investing. I hope this has given you some food for thought and perhaps even inspired you to consider sustainable investing as a viable option for your portfolio. If you found this helpful, don't forget to like and subscribe for more content like this.